afternoon. This is Cherie Andre, and I am the Client Relations Manager at Prestige Wealth Management Group, and I would like to welcome everyone to our quarterly economic update webcast. I will be the moderator for today's event. It is always our goal to continuously add value for our clients by educating and keeping them up to date on market and economic conditions. Today's discussion will be hosted by Roy Williams, President and founder of Prestige Wealth Management Group, along with John D'Angelo, the Managing Director of Prestige Wealth Management Group. And in addition, we would like to welcome Kevin Means, who is our Chief Investment Officer, as our newest team member. This conference call will be in a listen-only mode and should last about approximately 30 minutes. No participation is required. We cannot take any live questions during this call, but we do welcome your comments and suggestions. So at the conclusion of this conference call, please feel free to send us an email with your comments and or questions to pwm@prestigewmg.com. And with that, here's Roy.
Welcome, everybody. So on this beautiful sunny day in New Jersey, I have some, if you're a New Jersey resident, this is probably some of the greatest news I've had in many, many, many years, even though Governor Christie hasn't signed it. The New Jersey estate tax will be phased out over the next couple of years. I think it took the wealthiest person in New Jersey in the springtime, I think it was May or June, John, right?
Yeah.
Leaving New Jersey to push them to eliminate the New Jersey estate tax. So the reason I'm bringing this up, if you were thinking about moving to Pennsylvania because you're going to save on real estate taxes, then you're going to save a little bit on income taxes. Take a look at your inheritance taxes that you're going to have to pay there. You may end up spending more money by moving to Pennsylvania than less over time because of the inheritance tax they have when money is left to children in New Jersey. If you leave money to children, there's no inheritance tax. So if they're your ultimate beneficiary, again, New Jersey may be a better state to retire, as amazing as it sounds. The downside is that there'll be a 23-cent gas tax increase. New Jersey has been one of the lowest in the country for many, many years. But again, this will be beneficial to New Jersey to keep many wealthy people here, and it may even move some people to move from New York to New Jersey or surrounding states. So it may be very beneficial. So I just want to mention that great news. With that, when we start talking about valuations, Kevin, why don't you talk about in terms of where you think we are from a valuation standpoint? We recently moved up to where we're trading at almost 17 times earnings, forward-looking earnings.
Right. Well, actually, that's not so bad given the historical backdrop. If you look at forward earnings, if you look at trailing earnings, if you look at what's called the Shiller CAPE or cyclically adjusted PE, all of those are in relatively normal ranges. They're not extremely undervalued or extremely overvalued.
Yeah, and when we look at PE, it is relative because as over time, earnings do change. John, you and I were talking recently about oil, right? And the impact that could have on a positive basis.
Yeah, I mean, absolutely. I mean, I think, one of the themes that we'll be talking about during the course of the call is how important earnings season this quarter is to the markets continuing to have momentum, right? I mean, right now we're probably at fair value, and the expectation going into this earnings season is that we should see some earnings growth, kind of reappear that's been missing over the course of the last year or so.
If I'll jump in and say the anchor or the drag on earnings has largely been in the energy sector, and if prices continue to stabilize and maybe even get a little better in the energy sector, that could mean that their earnings will recover and start providing a positive increment of earnings to the overall S&P.
So when we look at this, we even had a question come in, are the markets overvalued? A lot of it depends. One, as we go forward, if you have an accretion from the oil and energy sector to the earnings of the S&P, if we have some positive earnings growth in that sector, then we probably aren't at fair value, and there may be some appreciation going forward. But again, the bet on energy, I mean, you have, you look at what's involved. I mean, we just, the U.S. government, Congress just voted to allow U.S. citizens to sue Saudi Arabia. Saudi Arabia owns almost $1 trillion of our debt. So, if they start selling, rates go up. So there's a lot that goes into, in terms of what will happen in prices. Will they dump oil because they're mad at us, and force prices down further? I mean, nobody knows what's going to happen. It's very, very difficult. Nobody predicted that we would have gasoline below $2 a gallon. As it is now, with the gas tax increase, we're going to be a little bit above $2 a gallon. But again, it's very, very difficult to predict, commodity prices as we go forward. But the hope is, and I've told a lot of you this, I'd rather have stable, and I think we all agree, I'd rather have a little higher energy prices and a stable world than low energy prices and a more unstable world.
Well, one of the encouraging signs for the stability of oil prices has been both Saudi Arabia and Russia recently have been talking about production cuts, which certainly has sent oil up to that, that resistance level, that $50 a barrel level that we'll be talking about.
And, when we look at, a lot of people have said, corporations, and we were actually having a group discussion before, haven't really, been spending money. And if you look at the slide, which shows in terms of how much cash U.S. corporations have on their books, they still have a tremendous amount of cash and cash equivalents on the books in terms of, and what they've been doing with that cash is buying back stock. Right, Kevin? And
right. Yes, that and paying dividends. And there's been some recovery in capital expenditures, too, as well as some M&A activity. So it's all been spread around, but they've been very profitable, corporations have, and they've been spreading it around between giving it back to the shareholders, basically in some cases saying, we can't invest this in capital expenditures and have an attractive rate of return, so we'd rather give it back to you, shareholders, either in the form of stock buybacks or in the form of dividends.
And if we look at capital expenditures, I mean, they've increased from the height almost $600 billion, but you have to also understand, we were discussing earlier, a big part of that is airlines purchasing all these new planes that they purchase.
Right. That's been that's a very interest rate sensitive kind of capital expenditure, and with interest rates as low as they have been, it really helps boost that kind of spending.
Yeah, and if we look at the corporate debt structure, even though we've seen corporate debt creeping up, a big part of that is companies borrowing money at these ridiculously low interest rates for future expansion and for future capital expenditures, because you can never get, they don't believe they'll get 4% rates again.
Right. In fact, we even had in the last quarter a couple of European corporations issue bonds at a negative interest rate. That had never happened before. Just an incredible phenomenon.
Yeah,
the European.
Yeah, that's amazing. That.
Well, I think that it's also correlated with the return of cash to shareholders. So I do think that some companies have been using debt at these very low levels and then financing corporate buybacks with that debt in order to increase their stock price.
And if we look at oil, I'll never forget this meeting. Alan Greenspan, frail as it is, standing up on stage. He had just retired as the head of the Fed. And obviously he can't, when we're at these meetings, Alan Greenspan cannot talk about interest rates because he has too much of an impact. He's talking about oil. And he was talking to a group of over 1,000 people how we're going to be independent of the rest of the world when it came to oil production. And all of us shook our heads thinking he was crazy. And if you look at this chart, he wasn't crazy. In terms of growth since 2013, the U.S. has been the leader in terms of growth in oil production. And probably will continue to be. Below the shale in Pennsylvania, the first place we discovered oil is oil. So as cost of extracting this oil in North Dakota, has come into play as the cost of extracting this oil continues to be decreased with advancements in technologies and processes, I think it's going to continue as we go forward. And again, that's why. And also, you have to remember oil. Now we have Iraq as part of the mix. And you think about it.
Well, Iran.
If we think about 25 years ago, we didn't have Russia. We didn't have Iran. And so we've had a huge increase in oil production, even with China's growth that they've maintained around the world. So, in the very not distant future, we'll be exporting. We'll be a net exporter, most likely, of oil. But still, from a pricing standpoint, it doesn't mean just because now we're independent, oil prices will go down, because, again, we're a world economy and a world market. So, again, by Russia and Saudi Arabia reducing production, that should normalize prices. And if you look at the drop, from 14 to 15, the end of 15, what happened with oil, it lost, almost 70-some-odd percent from a cost standpoint. And John, as we were talking about earlier, the projections with earnings, why are we seeing a big improvement in projections in earnings?
Yeah, I think this chart talks or speaks to it, right? So two areas that I think were a major concern last year going into the fourth quarter were, energy and energy sector earnings, and we're looking at energy sector earnings going into 2017 now turning positive. And we talked a lot last year about the headwinds of the U.S. dollar and how the U.S. dollar, the strength of the U.S. dollar, had such a negative impact on our global multinational corporations' earnings. And what we're seeing in this chart is that we're seeing these comparables now where the U.S. dollar is, stabilized, and in some cases, the expectation is that it should weaken. And with an expected weaker dollar and stronger earnings out of the energy sector, that could be very supportive of asset prices.
Mm-hmm. But again, you got to be very careful, John and Kevin, I'm sure everybody will agree, in betting on a sector like oil, because a lot of people placed bets last year. We went from having over 2,000 active rigs to a little more than 500 active rigs. So it depends upon the type of oil company, and there can be still some bankruptcies that we're facing going forward.
Oil earnings are coming back, but if we look at the last couple of years, one of the big problems in the energy sector is how much debt a lot of these companies have acquired on their balance sheet, and then their ability, with oil prices still being at relatively low historical numbers, having the ability to pay their debt.
Mm-hmm.
So there's quite a bit of, although we have encouraging signs, there's still quite a bit of risk in that sector, sure.
Yeah, and the dollar, a lot of people, we're looking at various research sources, predicting that the dollar may start to weaken, as we move ahead in the next couple of years.
Yeah, it depends. Partly it's on not only what the Fed does, because if the Fed raises interest rates more aggressively than the market's expecting, that could actually cause the dollar to strengthen. On the other hand, the reason they may do that also could come into play, which is economic growth in the U.S. If that is stronger than expected, that also could help lead to a stronger dollar. But what's happened recently is that the rest of the world has stabilized some, and it used to be that the U.S. was leading the way and was really the growth engine after China kind of, fell apart a little bit. But China stabilized, and so has the emerging market area, and so that's provided a little bit of competition for both the currencies and the economic growth to the U.S.
Yes, and if you think about it, Boeing, we talked about a lot of airline purchases. Boeing is not as competitive as they were with Airbus because of the weakness in currency.
Mm-hmm.
Change in currency.
Right. As Airbus being tied mostly to European currencies and to some extent in Great Britain. And the level of pound sterling has been at historic lows recently. So that's helped the UK stock market in the sense that that helps their earnings and their valuations.
So in terms of consumer finances, is it still a challenge to get a mortgage? Believe it or not, that if you have children or grandchildren, if they want to buy a house, they can actually still get a mortgage with 3% down, which is amazing. But we don't encourage that. We recommend that most people, when they buy a house, put 20% down. I'm showing my age, old school. That's what we had to do in buying a house. But if you look at the household debt ratio, it's at 10%, which is below historical norms, again, because it's, one way it's more difficult to accumulate the kind of debt that people accumulated during the financial crisis. And, again, the household net worth. So, I mean, this is, of a positive outlook in terms of that, you don't have bankruptcies up, you have consumers having money to spend, a lot of people. But obviously there's still some challenges in many sectors of the employment area.
Yeah, and on the other side of the coin, when we look at that chart, that could be the argument also of the negative of having ultra low interest rates for such a long time, is that consumers, rather than putting money into the economy or spending money, are spending their time paying down debt because there's no savings rate.
Mm-hmm.
Yep. Yeah, I think the Great Recession has caused a lot of caution for both corporations and for the consumer.
Yeah, and it's, it's not funny, but it is funny. Somebody came in, somebody's referred to us, and they brought in a CD that was at 6%, and I call it a dinosaur because you really don't see them. It was a 10-year CD that this person had, and, CD rates at 1.25%. People are happy when they get 1.25%, or special for 1.5%. Again, this is looking at cyclical sectors, and this speaks to as our recovery has, and again, when you look at this chart, my house hasn't recovered the way it, housing starts and some of these, but light vehicle sales being up, above the average is positive. Manufacturing inventories are, probably right where the average is. So, this is, again, housing starts. We're not back to the craziness. So I don't know if the average, if we look at the average from 96 to 07, how much of that was inflated by the situation we're in terms of everybody being able to get a mortgage very easily with no money down. But again, it's been a slow and steady progress, but it's been positive. And it's regionalized. I know in New Jersey, I hear from a lot of clients that they put $200,000 in their house between the outdoors and redoing the bathrooms and the kitchen, and they're selling their house for $500,000. They're actually losing money on the sale of their home. And as always recommended, your house is not an investment. It's where you live. So you never really buy a house because your money is going to double in 10 years. You buy a house because that's where you want to be, and it's the type of house that you want to live in. That's always been, my view in terms of that area. And it's also regionalized when we look at housing starts. Arizona's booming, and Florida's booming. Florida's booming because of the triple threat, no income, inheritance, or state tax. Arizona's booming because of California's excessive state income tax. A lot of people moving to Arizona. So, but in New Jersey, real estate's stabilized, but it really hasn't moved up that much. At least people are able to sell their homes now, which is, still positive. When we look at the growth of the population, going forward, what's forecasted, the increase of, from 18 to 64, this really speaks to, right, the boomers. We're talking, Kevin and I are boomers, and we're booming, in terms of every year you have 10,000 people turning 54, 50, all the way to 70. That's in the boomer category. If you just do the math, it's an enormous number of the population is aging. So what challenge, Kevin, will this propose as we go forward for our economy?
Well, our economic growth has really got two basic drivers. One is new entrants into the labor force, and the other is productivity. And on the first count, the new entrants into the labor force is really driven by demographics, and a lot of that has slowed down. You can see from the last bar on the drivers of GDP growth chart, whereas growth in workers had been north of 1.5% most of the time, now it's 0.5%, about a third of that. So our aging labor force means that fewer people are coming in to the labor force, and then on the other bar, the 0.9% growth in real output per worker means that productivity growth is not as high as it has been historically. That could be related to probably some slowdown in capital expenditures. Usually that's driven by the deployment of new technologies. Way back in the past, was the migration from an agrarian economy to an industrial economy. Earlier this century, it was driven by the introduction of electricity, the introduction of semiconductors and computers.
But microchip and
biotechnology has been a big area of improved medical care and so forth. And we really haven't seen tremendous breakthroughs in terms of technology that have really added a lot to productivity. It's been positive, but it hasn't been as strong as historically it had been on average.
But we do have Uber.
we have Uber, and some people would argue that, well, we have a lot of things that are benefiting us in terms of our lifestyle that are free because of the amount of stuff one can get now in terms of information, in particular on the internet for free, that is not measured in GDP, but is actually improving our day-to-day life, and that's probably a valid point.
Curious, Kevin, your opinion on what impact the underemployed might have on that number as well.
Well, the underemployed has to do with people just choosing either not to enter the labor force or to drop out of the labor force and are no longer looking. That's behind a lot of that 0.5% growth in workers, which is quite a bit lower than historically it had been on average.
No, and we've hit on a lot of this, in talking about, the foreign markets. It just illustrates when we look at, Europe, it still has negative returns in local currencies, even 2016 year to date. But emerging markets obviously has bounced back as oil prices have bounced back. Why would emerging markets prices bounce back as oil prices bounce back, Kevin?
Well, a lot of these emerging markets are really commodity-driven economies. They're often very much tied to oil or other commodities. To some extent, it could be agricultural commodities, it could be minerals, in addition to oil. So those are very important drivers for these emerging markets, and as the prospect of stabilizing, if not improving, prices for commodities starts to take hold, that affects their stock prices first, and it only later actually flows into the actual earnings and economic news.
Yeah, and we were looking at Brazil before the call, and John will tell you, my son wrestled in Russia, and the year he was there, the markets lost 80%. The year before, they gained 100%. And when you're up 100 and you lose 80, you have 60 cents on the dollar left. And really, when we looked at Brazil from the point of the financial crisis, you're still down over 60%. In some of these emerging markets. And the point of that is just, again, don't bet on a country. No matter how bullish you are. When things do fall apart is when people are most bullish. So we recommend, and again, emerging markets is part of our portfolio as a percentage of our international exposure. So it also gives you the greatest volatility in the portfolios. Last year, emerging markets were down about 17, 18%.
Right. I mean, it's the benefit of asset allocation, right?
Yeah.
Absolutely. In 2015, probably the worst performing area of the market would have been emerging markets.
Yep.
And so far in 2016, unless we have some type of major change, it looks like emerging markets will be the best performing asset class in 16.
Yep.
So that is exactly why we stay well allocated, and that is exactly why we are diversified.
When we look at the government, I talk about this. I keep mentioning the boomers, and again, we're not going to, I'll make my one political announcement. I've heard from too many people that they're not going to vote because they don't like either candidate. Again, we have that right as Americans to vote. And some of the local politics you can have a big impact on. I'll never forget that in one election, the mayor who won by one vote, and my wife and I voted for that person for mayor. So your vote can have an impact on other issues and other, races going on. So we recommend, whoever you want to vote for, vote, but, do vote, with the election fast approaching. In terms of the federal government, the deficit that we have, it's just, to still have an expanding economy and to continue to accumulate the deficit that we are accumulating is challenging. If in any economic study, having the debt structure impacts the growth of the economy, right?
Yeah, right. The percent of GDP of our federal debt level is, somewhat concerning. As recently as 1980, it was down in the low 20%. Today, it's at 73.6, as the graph indicates. That's a kind of level that we didn't have in, any time in the recent past. It goes all the way back to World War II, when we were, basically fighting for our survival when we had a level of debt like this. And it's not as though we're spending it on lots of roads and bridges. It's really mostly transfer payments for Social Security, Medicare, Medicaid, and so on that is being financed by debt. So we're financing these sort of current expenditures, kind of consumption items, instead of financing really capital expenditures.
And again, when we look at Social Security, Medicare, and Medicaid, as more than half the budget, if I look back in, we'll go pre-financial crisis in 2006, it was about 40% of the U.S. budget. And again, this all speaks to demographics and what's happening with demographics as the aging population. It also speaks to the conflict of interest our federal government has in rates going up.
Right. They like keeping rates low because they're one of the biggest issuers of debt.
Yeah, and most of our debt, so those out there are aware, is on a shorter term basis, not long-term debt. Is mostly in the short term. But again, our economy has picked up. Again, there's lots of things that we can do to help the U.S. budget, and hopefully, that happens going forward, because it'll continue to be a challenge. I just thought, real quick, we were talking about municipal bond debt, and really the purpose of this is a lot of people. We had, was it Detroit? Anyone bankrupt this year? I think we had Detroit 12 months. Detroit went bankrupt, and a lot of people are worried about local and state municipalities going bankrupt. And what's this really show, John, in terms of for state and local governments?
Well, one of the things that you can see is that from the debt service standpoint is that the percentages have come down. So their ability to actually pay on their debt has eased somewhat in the last couple of years. So municipalities, while they're probably not in the best historical shape, have been improving.
And they should be able to, most of them meet their debt service. You're always going to have an outlier, an inner city who, has a lot of challenges with expenses for revenues. If, they have low property values and not much revenue, and they have to have a large police force, for example. Somebody like Detroit, and they have less revenues because a lot of manufacturing has left that area, it's a challenge. So we look at the average price, and anybody in New Jersey will look at this chart and say, my house is not worth what it was in 2005, and that may be true. But again, they're looking on a national basis, and in other areas of the country, you've had real estate, in areas of South Carolina, Florida, Georgia. You've had real estate actually move up since '05. Where New Jersey, we're probably down a little bit. Well, but in this group, what I like looking at, and we're talking, is home affordability. It's very affordable for young people to buy a house.
Yeah, I mean it. As a percentage of income, mortgage payments are certainly low historically. Interest rates are at or close to record type lows. Which is supportive of price.
Yeah. And I mentioned earlier, it is tough. When you look at the FICO score of having to have 746, buying a new car or leasing a new car can bring down your FICO score.
Well, I think that's when you hear I guess you could say the Republican argument, right? If we talk politics, is that regulations within the banking industry have become so difficult or so high that the young first-time home buyers have kind of been pushed out of the mortgage market. So that argument is that if they could bring first-time home buyers back into the market, that it would be even more supportive of prices.
Yeah. And I think the first-time home market's going to evolve with the young people. A lot of young people want to rent and not own because they switch jobs every, 3, 4, 5 years as they start their career. And they don't know where they're going to end up, what state they're going to end up in, what area they're going to end up in. So a lot of times people push off, and that shows in the cost of rents. Rents are outrageous in most areas of the country.
Yeah, and I think millennials have certainly been renting. As a general rule, I mean, you can also add that, there's more of them have been staying home longer with their family as opposed to getting out of the nest, as opposed to buying homes. They're certainly renting homes, which the demand for rent has been so high that, it can be very supportive of rental income.
And there's been a delay in marriage. Household formation rates are not, as high, and people are just not getting married as young and having children as young or as frequently. And so it's had an impact on housing.
Yep. Yeah, I mean, you just look at Hoboken. Hoboken used to be a single town, and you see so many baby carriages being pushed around where a lot of young people are deciding to continue to rent and live in for a lifestyle. So this chart, when we're looking at the Fed, in my humble opinion, it's disappointing that the Fed hasn't moved a little bit more. And the reason why I'd want the Fed to move is just so we have something to counteract an economic slowdown. Right now, if we had a recession, there's not much that can happen from a Fed standpoint in terms of support. They can't lower rates. You can't go much lower than they're at now. But, if we look at where they were forecast, and, rates are actually down some of the rates for the year, right?
Yeah, I mean, Fed minutes are due out, obviously, later this afternoon. That should give us a little bit greater insight as far as what the Fed's looking to do in December. But at this point, I think consensus is that the Fed will raise rates by the end of the year. And I think what the market is really going to be looking at is what that statement looks like in December. Is it a hawkish statement? Is it a more dovish statement? Is it going to be something that's supportive of the economy and not shackle growth, but be supportive of what we would call that slow grind in interest rates, so that when we do move from late cycle to a potential recession, the Fed should have some bullets in the gun to be able to protect or stave off a recession by being able to cut rates.
And actually can have a very positive impact, as we were talking about earlier as a group, on the economy, because now people are earning more on their savings accounts than on their CDs, and they'll have more money to spend. you know.
Yeah, no question. I think that, what I would consider a slow grind north would be probably Goldilocks for both asset prices and the economy.
And, we've had recent, past few days, recent volatility in the market, and, it is very normal to have market pullbacks. We were in a period of time where we didn't have a pullback of 10% or more from 11 to 15, which is unusual. But having volatility is normal. Most of us, most economists don't see a financial crisis looming. There's nothing there for that. But we will have pullbacks. We'll have things happen. I mean, it could be a reaction to the presidential election, to either party who was elected. Whether it's Donald or Hillary, it could be a negative reaction to either one. So it's not necessarily
I think it would be very normal for the markets to potentially have short-term pullbacks. Both, could be based on earnings season. It could be based on the election, or it certainly could be based on a potential rate hike year-end, depending upon what that coinciding Fed statement looks like. But to your point, looking long-term, those potential moments where the market may pull back could present an opportunity, as opposed to being concerned about, a longer-term event.
Now, one thing, and John will tell you this is, I talk about this a lot, the probability of reaching. I was just at a wedding on Friday, and my friend's stepfather was 102, and walking with a cane, and his brain as sharp as could be. I love having conversations with him because he is so sharp. As the aging population continues to, or age increases, the average age increases in our population, it creates shortfalls as we go forward for retirement. So, and for pensions, because in the U.S. there aren't many companies, especially for new employees, that provide pensions. So it's real important for our children, for our grandchildren, and for ourselves to maximize, if financially feasible, the plans available to us and saving for retirement.
I think, to piggyback on that, Roy, I mean, when we think about the work that we do for our client base day in and day out, the financial planning work, and why we talk about that the financial planning is an important aspect for our clients' financial lives, is that if you look at this chart, on average across, the world, most people don't have enough money saved for retirement. And the reason they don't have enough money saved for retirement is because they don't have any type of a game plan. So what we provide here for our clients is an incredible benefit versus the average individual by just providing that framework.
And I would just add, don't expect the capital markets to bail you out going forward. The expected returns on both stocks and bonds are not probably going to be as high as they were as we look back over the last 20 or 30 years. So the bottom line is, in light of that fact, the spend less and save more. That's probably
which is a challenge to spend less for a lot of people because of the cost of health care. It's been
that's going to continue to grow.
Yeah, it's been a big challenge for people. So again, we want to close it with we appreciate working with everybody, and with diversification. We talk about diversification all the time, and having a diversified portfolio. Just because, again, nobody can predict as we go forward how everything's going to react. We're going to have an event. We have a great outside speaker on 11/2 at the Bridgewater Manor. Please bring guests. We've done this once before, many years ago, in maybe 2006 or 7, where we had somebody in to talk about identity theft. This is very impactful. We all have to be concerned about it. Just recently, we had a client tell us where somebody stole their identity, opened credit cards at Neiman Marcus, at Macy's, at Walmart, all these different stores up to whatever the maximum and only spent up to the maximum. So by the time they got the cards in the mail, they had spent, I don't know, $70,000, $80,000. And now they have to try and repair. So this is a very informative information session. It is financial, but it's not financial. It's really bringing additional resources to our clients to help them protect their financial assets as we go forward. Again, thank you so much for your time, and I'm going to hand it back to Cherie.
Thank you, Roy. And once again, thank you for joining us on this webcast, and we look forward to continuing our series of these calls with you in the future. We really do appreciate your feedback, so please feel free to send us an email with your comments to pwm@prestigewmg.com. And again, we do have that Identity Theft Workshop dinner on November 2nd at the Bridgewater Manor. We hope to see you all there. Also, just a quick note that if you haven't scheduled your year-end tax planning meeting, please give us a call to do so. Thank you, and have a great rest of your day. Thank you.